layoffs, and that's part of our thesis for a soft landing. And I think Powell sort of nodded in that direction by pointing out that vacancies are coming down, hirings are coming down, but firings are not really going up a lot. So I think that's the first point. The second point that I think is very much worth emphasizing, however, and Jay Powell was asked about this a little bit. He referred to the Bernanke and Blanchard paper, but we have been saying now for several quarters in a row, people overestimate how critical wage inflation is for the resulting consumer price inflation. They are clearly correlated, but most of the direction of causality is from consumer prices to wages. I am not worried about the current setting of wage inflation being the thing that drives inflation higher.
Mr. Carpenter, I've got 2.5 minutes left. Let's look at the heritage of Morgan Stanley economics. Steve Roach invented it. You followed on with great international economics. You come down the ramp at the Hong Kong airport, and there are the two billboards as Morgan Stanley greets you to China, greets you to Hong Kong, and certainly it changed Hong Kong now. Our Secretary of State will visit China. That is in the news today. And the great mystery is the strength of the Chinese economy and what it means for America. What is the reporting of Morgan Stanley on the strength of the Chinese economy?
Well, we remain reasonably upbeat about the outlook for Chinese economic growth this year, and it has been such a roller coaster over time. We were bullish on China a bit before the market was, and then the market got way over its skis when the first quarter data came out and the opening up process started happening. Now I see lots of people getting super bullish on China, and our view is and has been it will be domestic spending leading the way. It will be domestic spending on services. That's the biggest part of it. And if and when the rest of the economy starts to weaken, as we have started to see for some Q2 data, there's going to be some policy support coming out to keep the housing market from collapsing again, to keep infrastructure from being a drag on the economy. But no two ways about it, we think China is going to far exceed its official 5% growth rate target this year.
Seth Carpenter, thank you so much for taking the time, as always, and we look forward to catching up with you throughout the weeks ahead as we continue to contemplate the pace of disinflation and the nexus of China, which is actually really interesting, this idea that any stimulus could then reignite some of the growth that people have been looking for.
And it goes right over to the ramifications of the ESB. Good afternoon, folks. It's surveillance here for 15 hours. And what it goes over to, Lisa, here is the ECB and how they react to a hawkish Fed.
Right. The idea of a hawkish skip, a super hawkish skip. Over to you, Christine Lagarde. Tomorrow we will hear from her. Here's the score in markets. The NASDAQ still maintaining a gain up 0.1%. The S&P down about 0.1%. But I keep going back to what Jeff Rosenberg had to say about the Russell 2000. There you're seeing a material decline, regardless of any potential optimism about perhaps fewer rate hikes or a tempered Fed. That is where you're seeing it sell off almost 1% as people take a look at smaller companies and how much they're going to struggle. Or
they take a look at big companies, as we showed Apple earlier, buttressed right up against those recent highs, a little bit away from being a $3 trillion company. And to me, it's, again, I go back to my arch theme, two Americas, the haves and the have-nots. And, of course, Chairman Powell trying to speak to both parts of our economy. Let's be honest, there's a huge part of America flat on their back.
Which really is perhaps the reason why he started with saying our dual mandates. They want us employment. They want to bring inflation down. That was a nod, perhaps, to some of the political pressures.
We're looking at the markets now, the Dow, negative 266. The VIX is really interesting with a 13 handle here, 14.01 on the VIX. The market close here will be very, very interesting. A good minutes away, 15 minutes away from that. What we're going to give you, of course, is more reaction to the Fed decision, what it means for the American economy. Torsten Slok has been absolutely on fire at Apollo. He will join Jay Barry, co-head of U.S. rate strategies at J.P. Morgan, and we're thrilled to close out with our team here on a Fed Decides Day with Ethan Harris, Bank of America head of global economic research. We need to say thank you to all of you, and particularly John Farrow on assignment. We'll see you in July. The Fed decides. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:46 on Wall Street. We do check markets all day long. We've got 14 minutes to go ahead of the closing bell. With the Dow in the red, down 0.8%. The S&P lower, little change, down 4 points now, less than 0.1%. NASDAQ, though, remains higher on this Fed Wednesday, up 11 points right now, up by about 0.1%. NASDAQ 100 index up 44 points, up 0.3%. 10-year yield right now 3.80%, and the 2-year now yielding 4.71%. Stocks are fluctuating as Jay Powell seemed to downplay the central bank's economic projections by saying no decision has been made for the next few meetings after June's pause. But he also signaled that it will possibly take a while to be cutting interest rates.
It will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down.
Reaction to today's pause and the messaging from Diane Swank, chief economist at KPMG.
This is a Fed that is committed to additional rate hikes. The tricky part of this pause or skip, the Waller skip as we call it, was messaging it. And this was a very effective way to message, we're going to assess what tightening is out there and how much additional tightening is needed.
And again, we've got the 10-year yielding 3.80%, with the 2-year now 4.71%. Spot gold, little changed, higher by less than 0.1%, $19.45 the ounce. And West Texas Intermediate crude oil now down by 1%, $68.71 a barrel. Bottom line, Fed pauses raising rates, but signals more tightening to come. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week on Bloomberg Radio. We are live in our Interactive Broker studio. We are on YouTube. We are on Bloomberg Originals. Carol Master along with Matthew Miller.
She's back.
I'm back.
We missed you.
Well, thank you. I actually missed you guys, and I was checking in and seeing what were the top stories. And I love Fed meetings and Fed decisions. I know they get quirky. I know we pick apart like kind of every word that it comes out of Jay Powell's mouth.
That's why it's fun.
But that's why it's fun.
Yeah,
exactly, right?
Totally agree. I mean, we were just talking about the fact that Jay Powell says, don't call it a skip, which, like, to be honest, who cares if it's a skip or a pause or a hold?
Out of Jay Powell's mouth, we care.
He cares, and Lori Logan cares, and Fed watchers care, because they mean very different things when you're talking about the Fed than they would if you're talking about anything else.
I'm just going to say what blows my mind, a couple of years out for rate cuts. What? Wasn't the markets pricing in rate cuts this year?
Yeah, well, they were, for sure. At one point, we were pricing in like 4 or 5 rate cuts for this year, but now, no more.
All right, so let's get to it. We've got a great roundtable before we head to our TV colleagues and count you down to the close on this Fed Wednesday. So let's get to it. Liz Young back with us, Head of Investment Strategy at SoFi, on Zoom in New York City. Ira Jersey, our Chief U.S. Interest Rate Strategist, on the phone in New Jersey. And Liz, forgive, but I got to start with Ira because he's our rate dude. So Ira, walk it through in terms of what Jay Powell said, how the markets interpret it, what our Bloomberg audience needs to know.
Yeah, so what Jay Powell said was a little bit different than the dot plot, which was kind of interesting. And in fact, we have a natural language processing model, this neural net model that we use to parse his words. You guys were just talking about parsing every single word. So we looked at his opening statement, and it actually showed that it was even a little bit more dovish than last month, which really surprised us, given that he was talking about his colleagues saying that they might have to hike 2 more times, according to the dots and the like. So, a little bit of a nuanced Fed here, and I think that they don't really know exactly what they want to do at this point. Yeah. And
wait! I get a little worried when the Fed folks don't know what they need to do.
It totally seems like they have no plan. Liz Young, jump in here because there was no sense of extreme data dependence. Indeed, if they were following the data, they probably would have hiked this month. And when they were asked what data they liked more than the data that we were all following, they said, we'll know when we see it. Is that a little bit scary?
Well, I think the end of a hiking cycle, or at least the pause that happened today, is deceiving in the sense that there's this sort of illusion that it's creating more certainty, right? It's this illusion that, okay, they stopped. So maybe foot off the gas for now, not going to tighten monetary conditions too far, too fast, blah, blah, blah. But in reality, I think the uncertainty actually got worse because now we don't know what to expect. And we know that there are members of the FOMC who disagree on a number of fronts. Number one, how many more hikes are needed? Are there any more hikes needed? There are some members that talk about cuts still this year. There are some members that talk about not cutting until 2024, right? So I think it actually has increased the uncertainty for markets. And although today's vote was unanimous, I would expect that as we get through the next few meetings, these votes will not be unanimous anymore, and that's going to be tough to digest.
I love, our Kathleen Hayes, who follows all of the global central banks here for us at Bloomberg, and, she said, you got to remember that every meeting, basically, the Fed sits down and looks, right, Ira, at what is in front of it and then talks about it. So we can spend until the next July meeting speculating every day, every minute, but nonetheless, the Fed's going to sit down, have their lunch, and they're going to look at the data in front of them and make their decision.
Well, I think it's a little bit different because there are times when you have economic momentum that is clearly going one way, right? And I think the challenge right now for policymakers in the U.S. and indeed globally is that the data is much more muddied, right? We do see significant signs that the economy is slowing in general, but inflation remains too high, and then you get these very strong employment prints, and employment seems to be incredibly robust, right? Jay Powell mentioned that yet again today about how the job market is very strong. So I think that the fact that the economic data is very muddied right now is leading to this uncertainty about monetary policy. And in fact, what's interesting is that if you look at the markets and what the markets are pricing right now, the dot plot went up and said, hey, we might do 2 more hikes this year, but the market is barely pricing for one. So you're talking about a market that is still somewhat skeptical about the Fed. Now, the dots have never been right in a longer term horizon, but nonetheless, I think it signals that there are members of the Fed that, given the current economic environment and their forecasts, want to hike at least 1 or if not 2 more times.
Is the labor market really that strong? I mean, we have heard about Harvard grads who have to apply to 100 different companies before they get a job. We had a great story yesterday about how a kid who had interned at Facebook and Google and a couple of other big tech firms got his offer rescinded and had to go to a company I'd never heard of. Tech layoffs number 200,000 this year. And Danny Blanchflower has argued the unemployment rate really doesn't tell us what we want to know. Liz Young, what do you think? You're in a great position, actually, to judge. If the kids are getting jobs, I guess they'll be paying off their loans. How's it look to you?
Well, if we're asking, is the labor market strong just based on have there been a ton of layoffs and has the unemployment rate gone up? Then yeah, it's still strong, right? Because the unemployment rate hasn't really gone up. And even the tech layoffs that happened, they were sort of explained away by saying, well, those companies overhired anyway. There was bloat in the system. Tech doesn't make up a huge portion of the labor market, so the data didn't even really seep into what we're looking at on a headline basis and the numbers that we follow so often. I would suspect that if you peel back the onion and look at things like small and mid-sized businesses or just businesses across other sectors, that it's not necessarily that there have been mass layoffs, because we would have heard about that, but there has been a pause in hiring, or at least more discretion on how many people to hire and how fast to do that because of all the uncertainty that's happened in the economy. And to Ira's point, there's such a wide variety of views that you could take. And frankly, there's not irrefutable evidence on either side. There's the weight of the evidence, perhaps, on one side more than the other. And I've remained pretty cautious. I think the weight of the evidence suggests that there's probably some pain still to come and that cycles like this usually result in some sort of economic contraction. We don't usually just kind of skate by unscathed. But there's not really irrefutable evidence. And you could make the argument, you could even look at this Fed meeting today and make an argument whether they should have hiked, paused, or maybe even cut. Think about, I could sit here and say we're less than, we're more than 50%
It's like a great
down from peak
debate
inflation.
team topic, right? Because you could go a lot of different places at this point.
Right.
All right, Ira, I'm looking at your research this morning at 7:12 a.m. on the Bloomberg. Fed rate pause, return focus to ending balance sheet runoff. What's the headline for the research you're going to either put out later today or tomorrow?
Yeah, well, it's in the hopper right now. Actually, our reaction to the news. I think one of the things that we focused on, and we put this on the Top Live blog during the press conference, is if the Fed pauses sometime this year, which it seems like they will, right? Even they admit that there might be one or two more hikes, but at the end of the day, they're going to be done. Is then what happens with balance sheet runoff? Because even though Jay Powell today said that he thought that reserves would remain ample this year, our work suggests that the reserve balances will get to the what we call the tipping point, or the lowest comfortable level of reserves, before year end. So that means that you could eventually see balance sheet runoff in QT stop right around the same time that the Fed stops their hikes.
All right, Liz, saved you 20 seconds here. What's your focal point now when you think about the outlook here?
The outlook is the effect of the legs, and we are right in that window of when long and variable legs start to wreak havoc, or at least rear their ugly head. And I think we're going to start to see that come into the data over the summer and into early fall. So
yeah, I do wonder if now, Matt, we start to focus more a little bit on recession.
Yeah, well, you saw Ken Griffin said recession in 2024.
Yeah, could it be worse? Liz Young, Ira Jersey, what a dynamic duo for breaking down the Fed. This is Bloomberg Radio.
Counting you down to the closing bell. Full market coverage as we take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld. We're counting you down to the closing bell, and here to help take us beyond the bell, our friends Matt Miller and Carol Massar. Welcome to our audiences across Bloomberg Television, Radio Originals, and our partnership with YouTube. Carol Massar, we came into today knowing that this was going to be a pivotal day when it comes to monetary policy. We were expecting a pause. We got it, but certainly now a lot of debate about what they do next.
Yeah, we're just talking with Liz Young over at SoFi, and she's like, you kind of could have made the argument for pause, cut, rate increase, for a lot of things at this meeting. At this point now, I'm already thinking about July, but what I'm concerned about, what Jay Powell said in terms of rate cuts, that's a few years in the making, and that to me says an awful lot about at least the Fed outlook at this point, Matt.
It does, to me, seem strange that they weren't data dependent at this meeting, right? Because the data was hot. So if they had been, it would have been a hike. They do say they're going to continue to be data dependent, but when asked which data they're focused on, they said, we'll know it when we see it, which is a little bit worrisome, right? If the Federal Reserve can't really clarify the data points that they're watching, or at least they don't want to. They are still saying that the risk is to the upside for inflation, even though they added 2 hikes to the dot plot for this year. So it's interesting. They raised their inflation forecasts, they added 2 hikes, and they're still concerned about risk to the upside.
And just because I say skip doesn't mean it's a skip.
Well, and he made that clear, despite his Freudian skip that he had a little bit earlier here. We should point out they did actually raise their economic projections for GDP here. So maybe a case, I guess, if you want to sort of play devil's advocate here, that this economy and maybe the markets can withstand yet another rate increase later this year. Meanwhile, the markets appear to take it in stride. A bit of a round trip here, even though a lot of oscillations throughout the day. The Dow Jones Industrial Average lower by 200 points, or 0.7%. The S&P 500 is effectively going to close the day unchanged, but in the green, 43.72 and change, while the NASDAQ Composite up by more than 50 points, or about 0.4%. Meanwhile, the Russell 2000, that was a laggard for all day long, and it remains a laggard here at the close, down 1.2%.
Yeah, and I wonder, Romaine, if that's kind of telling in terms of the small caps and what it says about maybe some nervousness about the domestic economy here in the U.S. So I do think that's an important data point. Having said that, the S&P, like you said, we kind of almost ended where we were prior to the Fed decision. You've had just about half of the names, 208 higher, 292 to the downside. So that's kind of where we ended.
Well, we ended also, Romaine, to your point, over the past couple of days above where the S&P was before the Fed started hiking rates, which I just think is so fascinating that we've come full circle.
Yeah.
If you take a look at the industry groups, it's interesting to me that tech continues to climb, even though we got an extra hike in the dot plot. So IT was the biggest gainer on the S&P 500. Consumer staples make sense because if you're worried about the market in the face of higher rates, you're going to buy defensive stocks like that and real estate as well. But everything else was down.
All right, let's get to actually the names that actually showed some gains in today's session. So Nike, number one in the S&P 500. That stock ending up just about 5.7%, so just below its highs of the trading session. You know, there was some writing and reporting that that softer PPI report, you know, the prices of inputs may be coming down. And for a company like Nike, that means some of the materials costs are going to be a little bit lower, and that's going to improve margins and certainly their overall profitability. So maybe that's why you saw Nike a little bit higher today. Coherent, I want to go there. It's a semi-device maker. We continue to watch everything and anything in the semi space. Looking for, I think on an intraday basis, we saw about its biggest gain in about 2 years. Trading volume surging. Stock finishing up about 14%. The company unveiled new laser processing heads for high-speed precision welding that are primed for electric vehicle manufacturing. So that was a positive. And just real quickly, next decade, ticker is NEXT. That went up 51%. Wow. Yeah, exactly. This is after Paris-based Total Energies agreed to buy about a 17.5% stake in the Houston-based company. They're developing a terminal, to export liquefied natural gas, LNG, in Texas. So an energy play, right? Continues to be
and
out there.
I just want to add a couple more to that. Apple closing at another fresh record high. And then I thought this was interesting, Carol Massar, because I know you've covered the travel sector pretty well here. Delta Airlines, and in fact, most of the travel sector up again, and Delta's on like a 14-day run now. So you've seen a lot of strength in some of those, I guess, services and discretionary type of names.
Yeah. Exactly, right? People still flying around. All right, so who's going next?
It's me. It's me. I will add that there has been a lot of love for the cruise liners this week. But let's talk about decliners, since that's what I'm assigned to do. I want to start with United Health. Obviously, a lot of really interesting moves in the insurer space today. That's spurred by United Health. Basically, their CEO came out at an investor conference and said that seniors are catching up on surgeries that maybe they had deferred during the pandemic, think joint replacements. And then the CFO warned that second quarter premium revenue spent on care may be at the upper end or moderately above expectations. You're looking at United Health's worst day since 2020 as a result. Moving on.
And I thought it was interesting, too, not to knock you off here, but some of the big gainers on the day were like the medical device companies, basically the ones who would benefit from some of those price increases.
Yeah, maybe a pair trade going on there. Yeah, but let's talk about Cinemark as well, because that got a downgrade from B. Riley from a buy, saying that basically the film slate for 2024, 2025, it's looking increasingly uncertain amid that writer's strike. So that's an interesting name as well, also off by more than 6%. And finally, Fifth Third. Oh, go on, Romaine.
Well, with the movies, and you saw that Disney pushed a lot of their big movie franchises, the dates back a little bit, so interesting to see.
Yeah, no, it's getting serious. Yeah. So definitely some interesting.
I can't believe how big Avatar 2 even was. Like, did anyone you know see that?
No.
I didn't.
No. Or nor one.
Yeah, but 2.3, I mean, a huge draw for Avatar 2. It's worrisome that Star Wars has been pushed back to, I think, 2027. We're not going to get another one until 2027.
Well, some of those dates, they were like out into 2030. I was like, that's some long-term planning there. Yeah. Even the Fed doesn't project out that far.
They don't even know what data they're watching.
I'm still holding out for Cats 2, but I need to tell you about Fifth Third. Because
did you actually see Cats 1?
Yes. It was the last movie that I saw before the pandemic.
Of course it was.
Of course it was. It was great. We had a whole thing about it. Anyway, let's talk about some regional banks, because Fifth Third, one of several regional banks coming out today this week and warning about net interest income. Fifth Third saying today that it's reducing its guidance for full year net interest income. We also heard from the bank saying that it's no longer pursuing new office CRE originations. Of course, that's marrying together two concerns. You have regional banks, you have commercial real estate, and Fifth Third finished about 2.5% or so lower.
All right, let's go back to the macro. A quick check on what happened in the Treasury markets. A lot of volatility there, as you would assume, of course, on any day where the Fed makes a big rate decision here. Your 2-year yield drifting a little bit higher here on the day, only by about 3 basis points, but at one point it was up about 13 basis points, flirting with about 4.8% here. Meanwhile, the rest of the curve lower slightly here on the day, about 2 basis points on the 10-year, 3 on the 20, and 4 on the 30-year. But we should point out, guys, we continue to see kind of a deeper reinversion of that curve. Remember, back in March, we had started to see a lot of the main points on that yield curve start to get back towards positive territory. Not quite there, but now sinking much deeper at 2/10s, just to cherry pick one, right now at negative 91.
All right, so while we look at the rates there, and you talk about that, so important, obviously, coming off a Fed meeting, but I think about, guys, what Jay Powell said about being strongly committed to bringing inflation to goal. Strongly committed. Is that wavering a little bit, like we're going to do it? But I do wonder, that 2%, is that realistic? I think you talked to a lot of...
You're still hung up on 2%?
Well, I am, because if the Fed is still hung up on 2%, then they've got a long ways to...
They better be.
Well, they haven't backed off of it.
They've kind of been promising us that, right?
For decades.
Well, but I mean, but just to go back to the dot, I mean, they're not seeing 2% this year. What was it, like 3 point something at least for this year, 2023?
Do you remember when Ben Bernanke went on 60 Minutes?
Yes, I do.
During the
He
crisis?
said we could crush inflation at the drop of a hat, like no problem. We're worried about deflation. Well, now we see that just isn't really true unless they're fully committed. If they really want to beat inflation, they have to continue raising rates.
Haven't they beat it?
But have they?
I mean, and when I say beat it, I know. I mean, to Matt's point, no, they're nowhere near 2%. But when you look at a 4% CPI print, and I'm just talking about the headline number, 4% from 9.1 or wherever we were, and similar trajectory on core. I mean, there's an argument to be made that what they've done, whether that's directly attributable to those rate hikes, certainly has had an effect. That's a having in a
But they're
year.
forecasting for core inflation, right?
Yes.
Higher numbers for 2023.
Yeah, but just go ahead. I'm sorry.
No, but I guess my point is that, we know it wasn't going to be just a straight drop. And as you get closer to the target, it's
wants
tougher.
a straight drop.
I want it to get to the target. I don't need it to be a straight drop, but I think we need to bring inflation down over time to a much more reasonable level for people who live on a fixed income. And by the way, Katie and I talked to somebody today who watches the U.S. government and said fiscal spending could pick up next year. And that's just upward pressure on inflation.
No, we just had a whole budget deal.
I know, but Henrietta Trey's from Beta Partners told us she thinks fiscal spending could pick up anyway into 2024 as we get towards the election.
We're going to take this outside. Did anybody ask?
There was a whole entire bill. We would literally spend months talking about this. Remember that fiscal cliff, the debt ceiling? And then I thought there was all
Katie,
this.
can you back me up here?
I was there. We can roll back the tape.
Did I fall asleep? Am I like Rip Van Winkle? I just woke up in another dimension?
Did anybody ask Jay Powell what his favorite Dead song is? I mean, let's just get to the important stuff.
I don't think, maybe I missed that
I think
one.
it might be not fade away right now because of the inflation issue.
That's pretty good.
Nicely done.
Nice.
All right, on that, we're going to leave it. We will continue with Romaine and Matt, maybe offline. All right, guys, that's going to do it for our cross-platform coverage.
What's your phone number?
Radio, TV, YouTube, and of course, Bloomberg Originals. We'll see you same time, same place at 3 p.m. and 4 p.m. tomorrow.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week. We'd, of course, like to welcome in our Boston audience today, joining us on Bloomberg 1061. Welcome to Bloomberg Business Week with Matt and myself. Great to have you all with us. And we're going to be with you every weekday, 3 to 6 p.m. on Bloomberg 1061 in Boston.
Yes!
I love Boston.
I am pumped. I love Boston. I'm not going to say more than you, but I think it's possibly true.
All right, now you're getting dirty.
I have been able to fire howitzer cannons in Boston on more than one occasion.
Okay, fine. I didn't get to do
I met
that
the Indigo Girls in Boston.
I know.
And Amanda Gordon.
Melissa Etheridge.
That's true. I met her too.
Boston Pops coming up.
Yeah.
All right.
Very cool.
All right. Very cool. Very cool. I have to say that has been a really cool thing. We'll talk about that later. Anyway, we love Boston and its heritage. We also love some of the big finance firms and their backgrounds, their heritage, their ties to the big financial hubs like a New York City. And that kind of takes us to one of our most read stories on the Bloomberg. It happens to be also the Bloomberg Big Take. It's about how Goldman's biggest office beyond New York is a very telling story about one country's rise. So let's get to it and talk a little bit more about Goldman and really the global financial world and where its key hubs are. Bloomberg News senior finance reporter Sri Natarajan here with Matt and myself in our Bloomberg Interactive Brokers studio. Were you a little afraid to walk in because Matt was a little heated?
Of course. No. I've never seen anyone more excited about inflation than him.
This is why we love Matt, his enthusiasm over all things, including Fed meetings. Fed meetings are fun. Also fun is watching firms navigate politics and kind of the global financial world and where business will be and where they need to focus their efforts. Talk us a little bit about Goldman and what they're doing in India. And you know this country, right? Well, born there, family there?
Grew up there, yes. I do know the country a little bit. It is fascinating, the story, and it is a must-read. It is a window into Goldman, the fact that their biggest office outside of New York, their headquarters happens to be in India, in Bangalore. But equally, it is a story about how India has become a attractive center for a large number of firms. Goldman might have 8,000 of its roughly 45,000 people there. JP Morgan has about 50,000 people there, 50,000 of about 300,000. These are what they call these global capability centers. And that
so like when you call in, like, right, a lot of the back office?
That used to be the case.
Okay.
When you go back to the 90s, when you go back to the early 2000s, you would think about India, you would think about back office jobs, you would think about your, customer care centers. That's where most of your calls were getting answered, and that was the stereotype associated with India about the kind of jobs. But what the story does a good job of explaining to us is how that has changed. It's not purely back office anymore.
Sure.
It's not just that companies are sitting around and saying, how can we lower costs? It has evolved into something more than that. We have the head of India, the India business at Goldman Sachs, talking about how they have a number of software engineers there now building and writing code for their trading platforms that quant firms here can use for their commodities analytics business. That is not back office by any definition.
To me, it's a no-brainer, right? If I look at the landscape in India, the universities, the educational system is so strong that, we see, obviously, some of our smartest analysts here at Bloomberg Intelligence are from India, right? You look across the banking landscape, you've got some of the big CEOs are from India. To me, when I read this story, a light switch was flipped. Like, oh, obviously, you can hire PMs, you can hire business heads there, and you don't have to pay them, $10 million a year. I would move a lot of my business to India.
And move away from the banking landscape and think about the tech landscape. Google, Microsoft, IBM, all of these places. A lot of their CEOs right now are products of the Indian education system. And that's why it's important to sort of break down why it's so attractive, right? There is this vast pool of young talent. India just became the most populous country on earth, just overtaking China. Yet the median age here, and that is why this phrase has been associated with India for long, the demographic dividend. The median age there is 28. In the US and China, that's 38. 10 years doesn't seem like a lot, but it is a lot.
Yeah.
28 years old is sort of your average person in India.
I would give to be 28. You could take my left arm if I could be 28 again.
We can easily rewind 5 years, Matt, if that's all you want. But not just that. There's an educational system that has this focus on science and technology, right? That again becomes a big thing and an attractive quality for a lot of these companies trying to set up these centers. And the most important thing, the unforeseen catalyst. What happened with the pandemic? You learned that you could have your workers and your staff in distributed locations, in remote locations, and still do it seamlessly.
Right.
Of course, that was a very dire example, and people working from their bedrooms and their living rooms and trying to get work done, and we were able to do that. Here you're talking about fully constructed, state-of-the-art buildings with all the relevant technology that's needed. It just happens to be 12,000 miles away. That works, and companies are convinced that can happen. Of course, it's not all a plus. There are questions about the employability of many people who come through the booming education system.
Right.
They have to make sure that a lot of time is spent on training. And I actually remember that around the pandemic, there was a phase When the pandemic struck the US, that was March 2020, and that's when we saw most of the impacts. But the peak pandemic impacts in a place like India was felt about a year later.
Right.
And when you saw these national lockdowns, I remember having conversations with Goldman executives who were suddenly thinking, we have moved a lot of our risk functions and some of the other critical operational functions to places like India. When suddenly the entire office is locked down, they had a moment of panic and they had to be sure, wait, are we too reliant on India? Of course, it didn't cause any problems in the end, but it certainly sparked that conversation for them.
Shri, and I think about like China and what it developed into in terms of supporting the world, right, versus what India is. I mean, it's really a very different story, right? These are highly educated workers that are becoming increasingly a really significant part of the global economy.
China became a manufacturing powerhouse. It became the factory of the world. Looking at how this Indian ecosystem is developing, you are seeing more of a services export system here, right? And that is what it is turning to. It is using the demographic dividend to its advantage. It is using its existing education system and the focus on science and technology, or even the STEM fields, if you may, to attract a lot of these companies, and they're seeing the benefit in that. Goldman just opened a second global capability center in India in Hyderabad because there is an infrastructure challenge. If all the big companies are flocking to the same city, it will cause problems. And anyone who's seen Bangalore realizes there are problems. So other cities are developing. So there are alternatives.
What? Oh, come on.
I wanted to ask Sri, what is
He raised his hand.
I know many Indian students actually end up at Harvard as well, but what is the Harvard of India?
I believe how we call it, the Harvard University, for instance, is the IIT of the United States.
Oh, I see. I love the way he did that. He turned it around.
Ah, that is very interesting. It's, God, you know what I wanted to quickly, we only got 35 seconds. So when you see the headlines about Tim Cook and Apple and India, are they behind what the financial firms have been doing? Because it sounds like they've been entrenched on a much more sophisticated level in India for a while.
No, remember the Apple headlines and the Tim Cook in India headlines recently were more about Apple opening a retail store. That is a completely different side of the equation. There you realize that when you have 1.2 billion people and a very fast growing middle class, and that still translates to a pretty significant number, you have a consumer market that is approachable in ways you did not think possible many years ago. It is a growing market. Even with big investing firms, they will look at India as the good, with the growing depth in markets, the possibility to find investing opportunities there grow.
So glad you could jump in and see Matt's craziness and then do this story. Shri Natarajan, thank you.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 421 on Wall Street. We do check markets all day long at Bloomberg. Little change for the S&P 500 index, higher by 3 points at 43.72, up by about 0.1%. A Fed Wednesday, and today the Federal Reserve signaled the possibility of resuming its interest rate hikes after pausing its tightening cycle in June to assess economic conditions. Here's Fed Chair Jay Powell. You heard him live here on Bloomberg Radio.
Nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy.
10-year yield, 3.79%. The 2-year, 4.69%. Again, the S&P little changed, higher by 3, up by 0.1%. The Dow, though, down 232 points, down by about 0.7%. Nasdaq had a gain of 53 points today, up by 0.4%. Nasdaq 100 index up 0.7, while the Russell 2000 dropped 1.2%. Bitcoin at 25,527, down 1.2%. And spot gold today up $1.18 the ounce to 19.44, up 0.1%. West Texas Intermediate crude down 1.1%, 68.68 a barrel. Briefly, Citigroup CFO Mark Mason says the firm's recent job cuts will cause expenses to climb by as much as $400 million this quarter compared with the first 3 months of the year. Recapping, S&P up 3, up 0.1%. 10-year yield 3.79%. The 2-year 4.69%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Do want to welcome in our Boston audience today. Of course, joining us on Bloomberg 1061. We welcome everybody, and great to have them here with us, and looking forward to having them.
So I'm struggling to get Grateful Dead tickets for Thursday next week.
And in Boston?
Well, at Citi Field, but they're going to play in Boston at Fenway right after that. So maybe I should just go to Boston.
What a great place to see them.
And see the show there, yeah.
Like history coming together in like this mind meld.
And this is the last year that the Dead and Co. are going to tour. So
it breaks my heart.
It's all over.
You know, my brother had a Jerry doll that he hung on his rearview mirror. I know. All right, let's get to it. A little bit more Dead later on. Speaking of, well, I don't have any good segue, so I'm just going to go to it. We did see a major business story in the healthcare sector. U.S. health insurers plunging after comments from a United Health Group executive triggered concerns about rising costs. Device makers and hospital chains, meantime, were bolstered by the remarks because he was talking about people getting surgeries. So let's get to it. The United Health story, the importance of it, what they said, and what it all means. Bloomberg News healthcare reporter John Tazi is here with us, along with Glenn Losev. He's Bloomberg Intelligence Senior Equity Analyst for Healthcare, both in our Bloomberg Interactive Broker studio. Good to have both of you here with Matt and myself. John, I want to kick it off with you. Go through the news, and the stock was down about 6.5% here on the day, and it really did drag down the overall group. Tell us what was kind of key, what we got from that company.
Yeah, so the news is really remarks that came late yesterday from John Rex, the Chief Financial Officer of United Health Group, basically saying that so far in the second quarter, they were seeing a rebound in surgeries and other types of care, primarily outpatient care for their Medicare patients. That was going to kind of drive up the percentage of premiums that they pay for medical costs. And that's a really closely watched metric by investors. The comments sent down shares of United Health and other insurers pretty sharply, and also bolstered the shares of healthcare providers and device makers, because the thought is that kind of a rebound in care delivery is going to help the companies that supply medical care and make the devices for hip replacements, joint replacements, that kind of thing.
I know. I have a sister who just got a shoulder replacement.
My dad just got his hip replaced, and it worked out so well that he wants to go back and get the other one done. And obviously, this is something he wouldn't have done during COVID. He was, he's 75, so he was locked down and not going out. I read the story, the Bloomberg News story initially, and Glenn, I saw that they're going to use 82 to 83% of premiums to pay for these procedures. And I thought, cool, they have 18 to 17% margins. That's sweet. But you just explained to me that is not the case.
Right. Medical cost ratio is basically 82%, and
that's what they call that. They call that the medical cost ratio.
It's either medical cost ratio or medical loss ratio, interchangeable.
So that's how much it costs them to do it.
That's what they have to pay out.
Okay.
But there's obviously other costs, administrative costs, that sort of all pressure or add additional pressure to the company's operating margin. 82% is not bad. The John Rex stated that they're gonna see probably at the upper end of their forecast for 2023 in 2Q, which would be around 83%. So it's not the worst thing, but obviously when this comes out of the blue for most of the investors, they are concerned because expectations were much sort of that the year would be very sort of flattish.
Plus, it's not their margin, right? I mean, they have a ton of other costs besides just paying Stryker for a medical hip implant. They have the administrative costs, you were saying?
Yeah, they have just any other company. Medical loss ratio should be thought of as sort of cost of goods sold for any other non-healthcare company.
What's the Medicare, or forgive me, go ahead.
One thing to think about too with United Health Group is that they're both an insurance company, but they also are a care provider. They have their Optum division, which includes health services. They run urgent cares, ambulatory surgery centers. So they're actually doing surgeries, and so they and in the comments they noted that they've seen kind of the rebound in demand on their care delivery side as well.
And that's good.
That is good for their business, yeah. So they are sort of, involved both in paying for care, but also in delivering it directly.
What's the Medicare issue, John?
Well, the comments indicated that, the rebound in care activity was primarily in their Medicare Advantage business. So these are private Medicare plans that, health insurers like United Health manage on behalf of the U.S. government. They get a premium from the U.S. government to take care of people on Medicare. And it's an interesting business. It's been a huge growth driver across the health insurance industry, but it's also come under a little bit of regulatory pressure earlier this year in particular, with the government kind of reining in some of the payments they make to Medicare plans and adjusting other practices.
So, Glenn, is this kind of a 1 quarter, 2 quarter? Like how do we have to? I'm thinking about our audience who's listening to this and being like, okay, so is this just one little piece of bad news?
Obviously, we don't know, but we recently published our mid-year outlook.
Come closer to the mic, because we want to make sure everybody hears you.
Our mid-year 2023 outlook for managed care, and my view on this sector, that managed care companies are entering an environment where the premium cycle is ending, which is basically translates to revenue is slowing, and medical cost trend, not medical loss ratio that we've just discussed, are accelerating. And medical loss ratio is basically, or medical cost trend, is driven by care utilization and inflation. So, when revenues are slowing over the next 3, 4, 5, 2, 3 years because of economic headwinds and costs are going up, margins being compressed. So.
The irony of the story is you would have thought a global pandemic is bad for healthcare insurers. And it turns out that even worse is the end of a global pandemic.
Right.
And then I wonder, when we talk to catastrophe insurance companies during, say, a hurricane or floods, it's bad, right? But their stock goes up because they can then raise premiums. Right. Are we going to see that in this case?
Well, one thing that I think the company noted is that they've sort of accounted for these trends in their pricing for 2024 in their Medicare plans. And those are prices, bids essentially that the company has just submitted to the government this month. I think, it's hard to say kind of when you look across the sector or, other lines of business, whether, what exactly is going to happen. But yeah, I mean, the whole premise of the health insurance business is that they sort of price toward their expected future costs of medical care, right? And their business depends on being able to kind of accurately forecast those costs. So I think we should expect insurers to react to what they're seeing. If they're seeing an increase in utilization, that they'll price for that in future years.
Well, I think it's kind of relevant to our broader inflationary environment, right? We're going to talk with our next guest, who's going to talk about what it costs, the nursing shortages that are out there and what hospitals, and we've talked about this before, what they have to pay up to bring people in. That's just one component in terms of healthcare costs, but that certainly continues to impact them. Guys, thank you so much.
Thank you.
Really appreciate it. Glenn Losef, he's Senior Equity Analyst for Healthcare at Bloomberg Intelligence here in studio, along with John Tozzi, Healthcare Reporter at Bloomberg News here in our Interactive Brokers studio. I have to say, though, Matt, like you said, in my life, I just know a ton of people who are getting surgeries, and it's just been like running back after the pandemic.
Yeah, I don't get too many elective surgeries, but because of motorcycle and skiing accidents, I do end up in the hospital a lot.
You got a lot of metal in you, don't you?
And it's expensive, I have but it's titanium, so I'm pretty excited about it.
Is there any carbon in there, like those carbon fibers?
No, not yet, but someday, maybe a prosthetic.
Please watch when you cross the street. Yes. All right, folks, our thanks to our team here. Right now, though, let's get a check on world and national news. Off to D.C., our 99.1 newsroom, and Nancy Lyons. Hey, Nance.
Welcome back, Carol. Attorney General Merrick Garland is defending special counsel Jack Smith after Smith's historic indictment against former President Trump over his handling of classified documents. It all came up when Garland took questions today during an event on combating violent crime.
Mr. Smith is a veteran career prosecutor. He has assembled a group of experienced and talented prosecutors and agents who share his commitment to integrity and the rule of law. Any questions about this matter will have to be answered by their filings in court.
Garland says he followed regulations set forth for how and why an attorney general should appoint a special counsel to conduct an investigation. The Republican chairman of the House Homeland Security Committee is moving to accelerate hearings that could lead to the impeachment of Homeland Security Secretary Alejandro Mayorkas.
Chairman Mark Green accused Mayorkas of dereliction of his duty to protect the border, not only from migrants, but also from terrorists, criminals, and now
enemies of our nation have flooded across our borders. A massive surge in Chinese nationals, many of whom are military-age men who have crossed our southern border and just been released by Secretary Mayorkas into the United States.
Green said Secretary Mayorkas has also lied to Congress innumerable times, which is also an impeachable offense. In Washington, Irv Chapman, Bloomberg Radio.
Prosecutors now say the person responsible for a prop gun on the set of the Rust movie that caused a fatal shooting was likely hungover when she was preparing the gun. In a court filing, they say Hannah Gutierrez-Reed regularly drank and smoked marijuana, including the night before the incident. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long at Bloomberg. We are getting the latest numbers, latest quarterly numbers out of home builder Lennar. It is boosting its deliveries guidance for the full year. That guidance did beat analyst estimates. Shares are higher after hours by just about 4% right now. Lennar reporting second quarter revenue of $8.05 billion. Estimates were for $7.29 billion. Fed Wednesday and the stock market rally hit a wall today with the S&P 500 index little changed, up less than 0.1%. It dipped while Fed Chair Jay Powell was speaking. We had the Dow down 232 points, lower by about 0.7%. NASDAQ up 53, higher by 0.4%, while the Russell 2000 index of small cap shares fell today by 1.2%. But to be clear, the S&P did end the day higher by just about 0.8%. The Federal Reserve signaled interest rate hikes are still on the table after pausing its tightening cycle in June to assess economic conditions. But what about the question of rate cuts? Many thought could happen as early as this year. Here's Fed Chair Jay Powell.
It will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down.
So the Fed chair saying a couple of years out for rate cuts. As for market reaction, Liz Young is head of investment strategy at SoFi, and she was our guest right here on Bloomberg Business Week.
There's this sort of illusion that it's creating more certainty, right? It's this illusion that, okay, they stopped, so maybe foot off the gas for now, not going to tighten monetary conditions too far, too fast, blah, blah, blah. But in reality, I think the uncertainty actually got worse.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. 10-year yield 3.78%, with the 2-year 4.69%. Spot gold down $1 the ounce to $19.42. Little change there. West Texas Intermediate crude down 1%, $68.75 a barrel. Again, recapping, stocks end of the day mixed today. The Dow lower, S&P up by 3 points, little changed. And that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Matt Miller live here on Bloomberg Business Week, here in our Interactive Brokers studio on YouTube and Bloomberg Originals. And we do want to welcome once again our Boston audience joining us on Bloomberg 1061. They're going to be joining us 3 to 6 p.m. every day here.
We're with you from now on, Boston. And if anybody's got a spare ticket for the Dead & Co. at Fenway Park, I need a miracle.
All right. We're going to put that on the hold, but what we want to do is go back to the healthcare area. We talked earlier about United Healthcare's results. Back with us is Dr. Iman Abu-Zaid, co-founder and CEO at Incredible Health, on Zoom from Austin, Texas. Iman, so good to have you back here on Bloomberg. You always give us great insight early on in terms of what's going on when it comes to strains and stresses in healthcare. United Healthcare talking a little bit about, higher costs. Labor plays into that. Tell us about the state of nursing right now. Is it mirroring what you've been talking to us for years now?
Yeah, it is absolutely mirroring what I've mentioned before. But most recently, we did a study on healthcare executives, 100 of them, and just to understand their sentiments and what they're saying. And so they echo what you just said, in that the costs are increasing and labor expenses continue to go up. But they're also describing just that the nurse shortage is critical at this point.
So the nurse shortage seems to have been critical for a while now, right? We've heard these stats since I was in the hospital for a motorcycle accident like 10 years ago. And I will say I spent a lot of time in the hospital since then. Nurses are angels. I mean, for me, at a lot of points, they were more important than doctors. So what can be done about this? Why don't we make it better?
Yeah, so, just digging into the problem a little bit more from the perspective of the hospital executives is that they're reporting that 53% of their nurses have very short tenure. They've only been there for less than 5 years. And over time, their nursing workforce is getting younger and younger because they're hiring new graduate nurses instead of just only experienced nurses. What that's creating is just a generational difference that's happening in the nursing workforce today, where we're having more nurses, particularly those that are younger, request things like more flexible scheduling, pushing for more compensation, pushing for more specialization earlier in their careers. So the nursing and HR executives that are sort of responding to that with stronger tactics on flexible scheduling, career advancement, are tending to having more success with nurse hiring and retaining their nursing workforce as well.
You know, there's one stat in this survey that you did with health system executives. 40% of them reported that more than a quarter of nurses in their system have less than a year of experience.
That's nuts.
Yeah, that seems, as Matt said, I've been in situations, Matt in particular, though, where you know nursing care is so important to your care and your ability to recover. That seems worrisome.
It is worrisome. It impacts patient quality, the quality of care and safety when you have more and more newer or less experienced nurses on the floors compared to experienced. What hospitals have to do is make sure that the onboarding and training for these newer nurses is top notch. And they're trying to supplement with as many experienced nurses as possible so that they can oversee the work that's happening. But as far as patient care goes, that is very concerning because it means the safety and quality risks have just gone up.
I know that, and a lot of people don't realize, travel nurses make up a huge part of many hospital staff. And a lot of these travel nurses are sent to various hospitals by agencies that take giant chunks of their paychecks. How do you see that going forward? Because surely there's got to be a better way in this day and age of like gig economy that you don't lose 30% of your paycheck to an intermediary.
Absolutely. So 93% of hospitals in our survey are still using travel nurses, but they view it as a Band-Aid solution. It's a temporary solution, and they're trying to do whatever they can to fill the roles with permanent nurses. Because the other challenge with travel nurses isn't just the increased costs and agency taking parts of their wages, but also that they're impacting the hospital's bottom line. The more temporary workers you have, the lower your quality of care as well. So there is a lot of pressure on hospital leaders today to reduce the number of travel nurses and to hire more permanent nurses.
Dr. Abuzaid, I use the word crisis carefully because I don't want to be inflammatory, but I do wonder if we have been talking to you for a while about this, and I keep thinking, are we going to get to a point where, I'm sorry, I know you're scheduled for procedure, but we can't do it today because we don't have the nursing care to support it. Is that where we're headed?
We are, and I mean, we're already there.
Yeah.
We can't. Hospitals are not able to operate as many operating rooms as they would like. They can't open as many facilities and units as they like because of the shortage in staff. And so when you look at the statistics, even from the U.S. Bureau of Labor Statistics, the projections for that healthcare worker shortage is going to continue for decades to come.
So what are the solutions? I mean, you can offer more pay, obviously.
Open up immigration.
Open up immigration. Yep.
Absolutely. Open up immigration. So get more nurses from outside of the country into the U.S. You can also relieve the bottlenecks at the nursing schools. So there's many Americans that have applied to nursing school and they're on wait lists, but the nursing schools cannot train enough because they don't have the facilities or the faculty to train more, to provide more funding and support for nurse training after nursing school. That's another bottleneck that's happening. So there's multiple solutions, and it's going to take all of us, whether it's government, technology platforms like ourselves, or hospitals and health systems, to address it.
Well, you see the government impact, whether it's the semiconductor area, whether it's renewable fuels, alt energy. Does the government need to do some kind of task force to some extent, or provide funding to change things?
Absolutely. I mean, one of the sort of more straightforward things they can do is open up immigration for this specific workforce.
Yeah, it seems so simple and would solve so much.
I don't understand why this administration hasn't done more to open up. I'm not talking about, bringing in immigrants. There are already so many people here waiting for green cards. Just process that.
I don't disagree. And you talk to economists, how it would solve so many different things out there. Some of the labor stress. a lot of things. Dr. Iman Abu Zaid, always fun to check in and informative. Co-founder, Chief Executive Officer at Incredible Health on Zoom from Austin, Texas. I'm Carol Massar, along with Matthew Miller. You're listening and watching Bloomberg Business Week.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. That 13-day winning streak for Tesla came to a halt today. Tesla shares declined by 0.7%. A lot of news about the EV maker today. Among the stories, Tesla is increasing the starting price of its Model Y SUV in the U.S. for the third time in the past 2 months, adding $250 to the cost of the base version of its best-selling car. Ed Ludlow is following the story for Bloomberg News.
Pricing has always been a lever for Tesla. You know, that Elon Musk has taught pretty consistently that in order to protect growth and volume, they're happy to sacrifice profits. You know, at the beginning of the year, they cut prices to great effect and unlocked a pocket of demand in January. Elon Musk talks about demand being twice the rate of production after they had cut prices. Now we've seen them ramp back up again. $47,740 is the starting price for a Y. You compare that to the US median or mean average price of a new vehicle, it's still slightly below, so it makes them competitive. It's a lever.
And again, Tesla shares did decline today by 0.7%. Charles Schwab says it expects second quarter revenue to decline by as much as 11%, citing a smaller interest-earning asset base along with softer trading activity. The home builder Lennar is boosting its deliveries guidance for the full year. That guidance did beat the average analyst estimate after hours. Lennar now up by 2.8%. And those are some of the top company stories we're following this hour. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Well, Carol's here, but Tim is out. I'm filling in for Matt Miller, your summer intern. I just want to quickly talk about one of our sponsors. The Tri-State Business Report is brought to you by PPAC Private. While others dream, PPAC Private Wealth Management clients achieve for advice and planning, investment management, and trust and fiduciary solutions. Visit ppacprivate.com. Not FDIC insured, no bank guarantee, may lose value.
All right, you are listening and watching Bloomberg Business Week. Let's get another update on world and national news. Back to D.C. we go, and Nancy Lyons. Hey, Nance.
Thanks, Carol. We could possibly see former President Trump's federal trial on classified documents begin in months. That's the prediction from Nick Ackerman, who is a former assistant special Watergate prosecutor. He tells Bloomberg Trump is not the subject of selective prosecution by the Justice Department.
This is not like Joe Biden or Mike Pence, who had a couple of documents in their possession, immediately turned them over once they discovered that they had inadvertently taken them. This is not the same situation. There is no parallel in that. This is simply a bogus argument to kind of cover up for Donald Trump.
Ackerman says, like Watergate, the big crime here appears to be the lying and the concealing of facts. House Republicans are launching an investigation into Homeland Security Secretary Alejandro Mayorkas. Congressman Mark Green chairs the Homeland Security Committee.
Mayorkas' dereliction of duty has placed the safety of Americans second to his own personal agenda. With hundreds of thousands of dead Americans due to the poison he has allowed the cartels to bring into our country, with the deaths of sheriff's deputies executed by criminal aliens.
Despite Green's accusations, numbers from the Department of Homeland Security show a decline in migrant crossings to the U.S. The department reports unlawful entries along the southwestern border have decreased by more than 70% since the end of Title 42 in May. The largest Protestant denomination in the U.S., the Southern Baptist Convention, is rejecting efforts to allow women pastors. Delegates to the denomination's annual meeting have voted to deny appeals by California's Saddleback Church and Kentucky's Fern Creek Baptist Church to rejoin the faith. Both of them had appointed women as pastors, a role that the church's statement of faith says is reserved for men due to the teachings of the Bible. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carol and Matt.
Thank you. Nancy Lyons in our 99.1 newsroom in the nation's capital. Carol Massar along with Matt Miller. Did you see the story, Ken Griffin and Citadel? It's among our most read on the Bloomberg today.
I did. He's predicting a recession for 2024. I'll tell you what, I listen a lot more closely after seeing the performance. Citadel has absolutely trounced all comers in terms of hedge fund performance.
Yeah.
And with a record that good, you can't afford, I think, not to listen. Wait. Yes, that's right. You can't afford not to listen to Ken Griffin.
I get those moments. His fund, his flagship hedge fund, gaining 6.1% through May. You're right. It's not always been a sure thing when it comes to the hedge fund industry, right? Over the last couple of years, we've seen increasingly a lot of underperformance. Certainly when it was easy to just throw everything in an index fund and you were off and running. They had a tough time. But this story, he is ramping up some of his credit bets. You said he's anticipating a U.S. recession. He says we're much more cautious about 2024. We're going to look at the credit markets as a source of opportunity. Credit should be a meaningful contributor later this year. I think he did an event.
The credit markets is a question mark for me because as we head towards a recession, do you really load up on credit? Isn't that when more defaults happen? I realize you get paid more, right? And if you make the right choices,
well, you load up